Welcome to Capital Link's company presentation series.
Welcome to Capital Link's company presentation webinar series. In this series, senior management of listed shipping companies provide an update on their operations, business development, strategy, and sector outlook. I'm Nicholas Bornolis, president of Capital Link. Capital Link is an investor relations firm also active in event and conference organization. We work with several private and publicly listed companies, including companies featured in this webinar series. As noted in our disclaimer, these presentations are purely for informational and educational purposes. They do not constitute investment advice or advice of any kind, and obviously Capital Link bears no responsibility for them. Today, we have with us the senior management of Scorpio Tankers. We have with us Mr. Robert Bugbee, president and director, and we have Mr. James Doyle, senior financial analyst. The whole session will take 45 minutes. We will start with a brief slide presentation, followed by a live Q&A session. Please submit your questions through the Q&A button at the bottom of your screen, or email your questions to us at webinars@capitallink.com. Thank you to everybody for being with us. Without any further delay, I will turn the floor over to James to take us through the presentation, and Robert is going to join us for the Q&A.
Thanks, Nicholas. Eleni, could we please put up the presentation to slide 5? Excellent. Great. So Scorpio Tankers owns and operates the largest and most modern product tanker fleet in the world. We have 131 vessels comprised of 4 different asset classes: the Handymax, MR, LR2, and LR1, all of which serve different regions and routes. The average age of the fleet is 6 years old, which is significantly less than the existing fleet, as you can see on the right. And all of our vessels are eco vessels. So they're modern vessels that consume less fuel, generate more fuel savings, and emit less CO2 and NOx and SOx. Next slide, please. In addition to being eco vessels, 91 of our vessels have exhaust gas scrubbers. Scrubbers allow the vessel to consume less expensive fuel. The fuel savings vary by the spread and by the vessel type, but the current VLSFO HSFO spread today of $150 a day is generating daily fuel savings of around $1,800 on our smaller vessels and $2,500 on our larger vessels. If the current spread remained for the remainder of the year, the company would generate $77 million in fuel savings, or $1.30 a share. Next slide, please. While COVID has created a challenging rate environment for product tankers, the company has been able to maintain strong levels of liquidity through refinancing our fleet. After the completion of committed financing and financing under discussion, the company will have pro forma liquidity of $308 million. Next slide, please. We have recently dry docked the majority of our fleet, and given the young age of it, have no new build CapEx for fleet renewal. We have financed all our upcoming maturities, aside from a $69 million convertible bond due in the second quarter of this year. Next slide, please. Scorpio Tankers has significant operating leverage and potential cash flow generation. When rates move from $20,000 to $25,000 per day, a 25% increase, free cash flow increases from $421 million to $665 million, a 57% increase. At $20,000 a day, the company generates $7 a share in free cash flow and $11 per share at $25,000 per day. Next slide, please. Before we discuss the market, I wanted to highlight asset values. While everyone is focused on rates, we've experienced a substantial increase in asset values over the last year. Rising steel and labor costs, as well as new building orders from other segments such as containers, has filled available yard capacity. Since January 2021, the 5-year-old LR2 value has increased by $12.5 million. If we apply this increase to Scorpio Tankers' 42 owned LR2s, it would increase gross asset value of the LR2 fleet by $525 million alone. So don't sleep on what's happening with asset values. Next slide, please. Oil demand by use. I thought this was important because when we think of oil demand, we think of the cars we're driving, trucks that are delivering our Amazon packages, or planes taking us to our next vacation. While transportation is the largest consumer for the end use, over 40% of oil demand is used for petrochemicals, industrial, and other segments. We expect all sources of demand, aside from electricity generation, to increase throughout the next several years. Next slide, please. As economies reopen and vaccination rates continue to increase, personal mobility will increase and consequently oil demand. We expect oil demand to recover to pre-COVID levels this year and for demand to improve sequentially each quarter. Over the last few weeks, we've already seen various agencies announce and revise demand upward for last year and for this year. We think this trend will continue. Next slide, please. One of the laggards for product tankers, refined products as a whole, has been jet fuel. Travel restrictions, lockdowns, and other restrictions on personal mobility have impacted jet fuel demand. And although it's doubled since early April of 20, we're still below pre-COVID levels. And I think a key driver will be the return of international and business travel. Next slide, please. However, despite lagging jet fuel demand, we think that the refined product market will increase to above pre-COVID levels by the end of the year. And this is due to larger increases in gasoline, diesel, and naphtha, which will offset the lower jet fuel demand. We would expect that this year we see a sequential quarterly recovery in refined product demand, and could expect that to apply to rates for our vessels as well. Next slide, please. So a challenge with the product tanker market and probably the crude market as well has really been inventories that started during COVID-19, as well as just the impacts of the pandemic itself. But if there's any evidence of a demand recovery in refined products, it's draws in gasoline and distillate inventory shown in this graph. 2020 was a difficult year for refiners. You can see that those inventories kind of moved up and down, and obviously was severely impacted by COVID and lockdowns. But in 2021, gasoline and distillate inventories declined by 181 million barrels through November, even as refinery utilization increased. Next slide. So when we look at refined product inventories, they are approaching historically low levels. Inventory draws have really come at the cost of product tankers, but we're getting to a point where we're going to have such low inventory levels that something's going to have to change. So refiners are going to have to increase output as demand picks up here, and some of these exports are going to go on a product tanker. And so we expect, obviously, our outlook for 2021 to be quite significant. Next slide, please. One of the bigger developments in our space is what's going on with refineries. In the last 2 years, we've seen a significant number of refinery closures. These closures are of older, less efficient, poorly located refineries where the margins are not great and the maintenance capex to keep them running just doesn't make sense. In addition, there's also been increased competition from overseas. So for the first time in 30 years, refinery closures outweighed new capacity in 2021, leading to a drop in global capacity. And when you close a refinery in a country with limited production or limited other capacity, and even a flat to increasing demand curve, you need to replace the lost production. At the same time, we've seen or will see this year about 1 million barrels of export-oriented refining capacity coming online in the Middle East. Now, this is massive for our product tankers because we're getting closures in smaller markets that are going to need to import product, and we're getting openings of larger export-oriented refineries, which is really, really great for our business because two of the biggest demand drivers are the amount of cargo we're exporting and the distance it's going. The distance it's going times the quantity of the cargo is called ton-mile demand. So next slide, please. So if we take a look, this slide we put out when Australia announced that there would be 2 refineries closed, Altona and Kiwana. And These two refineries amount to about 236,000 barrels a day. And we wanted to highlight what could happen to a place like Australia that's far away and needs to import product, especially when refineries close. So to replace this lost production of 236,000 barrels a day, Australia would need to import about 86 million barrels of additional refined product per year. And by our calculation, these closures alone would increase product tanker ton miles 2.1%. So not only are exports going up, but the distance and capacity that's tightening from this is quite significant. Next slide, please. So what we've seen here, and it's been hard because demand data always lags. And obviously the impact of COVID has made looking at data even more challenging and hard to see the impact of what's happening with these closures. But as you can see here, quite significantly in November, we saw a massive uptick and really starting kind of as these closures happened last year in imports to Australia. We've seen it on our vessel, but here it is, the demand telling us. Next slide, please. So the demand side is really exciting as we get out of COVID, but I think what's happening in the supply side is really, really interesting. And if you look at where the order book is today, it's at a historical low, 5.6% of the existing fleet. And like I mentioned earlier, we've seen this uptick in asset values. However, this uptick has not really translated to more orders on the product tanker side. It's typically been containers, gas vessels who are having much stronger markets right now. However, it still takes up the same slot at the yard for specific types. Next slide, please. And so when we look, this is everything that has been ordered as of today. So 131 product tankers, and they'll deliver over the next 3 years. However, what's happened with the yards is that because they are so booked with other vessels, the time it takes to get a vessel delivered increases. So not only are the number of vessels on order at an all-time low, but the time it takes for you to get that vessel delivered is probably at close to an all-time high. Next slide, please. Now, while this is all going on, the number of product tankers scrapping is at a record high. So we've got a record low order book, record high scrapping. And this was in part due to higher steel prices, but also the age distribution of the fleet. Because product tankers were not built in mass until the early 2000s, very few vessels have left the fleet. You've essentially just had fleet growth. And this is going to change drastically over the next few years. Next slide, please. But putting this all together, we expect a significant recovery in exports this year. We saw about half of what was lost during COVID last year, and that's just on the export basis. But at the same time, we expect minimal fleet growth over the next 3 years. So for the next 2 years, about 1.3% net fleet growth, using very conservative scrapping assumptions of the 20-year average, which you know is quite low. And without additional new orders, we hit negative fleet growth in 2024. Now, what's not pictured in this graph is ton miles. So ton miles we expect are likely to reach above pre-COVID levels at some point in the middle of next year due to the refinery closures, while exports probably reaches pre-COVID levels somewhere in between Q4 of next year. Next slide, please. So when we looked at the supply graph, right, and the net fleet growth, we saw how low it was. But to give you an idea on the age distribution, what makes a product tanker is the epoxy coating inside the ship. And our customers have a huge concern for the quality of those epoxy coatings because, unlike crude oil, refined products can get contaminated. And if you can't properly clean your tanks, you risk cargo contamination. So certain of our customers will not employ a ship that's 15 years and younger. That ship still has a useful life and can do crude oil voyages, or it can go trade in places where restrictions are a lot lower, regional markets, but not competing for that top business. But because of the age distribution of the fleet here and the lack of new building orders, there are a significant number of vessels turning 15 years old as well as 20 plus old in the next few years. So assuming we don't have any additional new building orders, so just the ones that are on order deliver over the next 3 years, and we're not assuming any scrapping, the number of vessels from 15 to 19 years old increases by 223, and 20-year-old vessels by 420 vessels. So essentially what you can see here is more than half the fleet, right, is older than 15. Next slide, please. Lastly, I'm just going to touch on environmental regulations in our industry. We see environmental regulation for the shipping and maritime space increasing and becoming more stringent rather than less. The timing and implications of these regulations is still to be determined, but in any scenario, we see that regulation will benefit a modern fuel efficient vessel because it emits less carbon, less greenhouse gases. And so any measure that they put in, such as a carbon tax system, will likely slow the fleet, but it will also change some of the trading dynamics of older vessels and modern vessels. And we think we're in a really good place for those upcoming changes. Next slide. So just to recap here, we think 2022 is going to be a recovering year for refined products and tankers. We have large increases in ton mile demand of 9.3% and exports coming up 5.7%. We think the refining capacity closures are going to have a large impact on ton miles, as well as the openings of new refineries in the Middle East. The limited new building orders, the high scrapping and aging fleet sets up a really nice supply dynamic, and environmental regulations over the next few years are likely to further benefit modern vessels, as well as probably the whole fleet in terms of slowing vessels down. Thanks, and I will turn it over to Q&A.
Thank you very much, James. I think we can also get Robert on, so we can start our Q&A. So we have a number of questions already in the pipeline. Robert, I will start with one that I think is, I wouldn't say the topic of the day, but a very interesting topic on everybody's agenda. Hafnia announced a potential acquisitions of vessels. What can you say about this?
We haven't denied what Hafnia have announced. That's what I can say. I think I would go further and say that in broad sense, I think that we would see great value in, as we've said before, Christmas that we would be looking at selling vessels as a very good measure, in the sense that at that time the market had our NAV on their own valuations, for example, at $25, and our stock was trading at 12. If you took the values ascribed by let's say trade winds to what LR1s could be, and then we would have a value well over $30 on an NAV basis. So I think that the first comment would be, there are a couple of comments. The first comment is that, as James said, values and interest, more importantly interest across the board for modern product tankers has accelerated quite sharply. There's a combination of the expectation that COVID will end, that demand will accelerate, that inventories are at almost at record lows across the product space, that supply measured in terms of forward utilization is low. So all of the players can see this. And then there are new players too, because people have made a fortune in containers and dry bulk. Many players that are not necessarily product tanker players are looking to acquire modern product tankers. So That's what's driving the prices up. I would say that it's a very firm market for the seller. There's, the idea of a fire sale in inverted commas for anybody in products is sort of a little bit ridiculous. And, that's not what the definition, selling vessels at prices that are higher than what we've seen in the last 5 years, and in some cases values in the last 10 years, can't really be described as a fire sale. You would be describing it as a seller taking the opportunity of very firm prices against a very weak stock price. It's about,
yeah.
In time we'll be able to comment in what we have done, and we're quite excited about what we're doing.
Well, the other question, but I think you addressed it already, is how do you feel in general about potential asset sales at current prices? But I think you already answered that. I don't know if you want to add anything.
Yeah, I think it's one of those magic moments that for the buyer, it's great value, fantastic value, what the prices are doing. Forward charter rates are reasonably firm. The market is structurally set to accelerate and go into a multi-year bull market with what is happening. And and for any any public company that's trading at such dislocations to the net asset values and has such a huge fleet of ours, so you're hardly affecting the operating leverage of the company to the upside. It's just a win-win all round. And that's how I would describe the present thing. But it's as James said, it's across the board. They could be LR1s, they could be MRs, they could be LR2s, just as long as they're modern.
Okay, without putting you on the spot, I find it very interesting, obviously, from your point of view as a seller, that allows you to capture the difference between NAV and market price. That I think it's very straightforward when the buyer is a private company, but it's more interesting when the buyer is another publicly listed company. So,
well, it would be more, it would be, if that's a comment to the actual announcement that Hafnia made, look at it from their point of view, or if the announcement they made is they said, well, we're buying a fleet that we are the market leaders in anyway. Okay, and that's a real modern fleet with scrubbers fitted. So for Hafnia, that announcement is a perfectly logical announcement. This is a really great company that has very, very good chartering. And then for any other participant in the market of products, what a fantastic thing that there is that Hafnia's announcement indicates a form of consolidation in the market. This is a very rational move for potential move, or whatever potential announcement that Hafnia have made, indicating a very strong rational decisions from parties in the market.
Very interesting. Well, I have to say, again, that's not a question, it's more of a statement from me. I find it particularly interesting or amazing all the time when we come to shipping and we talk about stocks trading below NAV, especially when you have, like in the case of dry bulk, for example, or containers, cash flows locked in that are very robust. So it is really interesting.
Yeah, but if you take the product market, it's not surprising, or the tanker market, rates have been very poor. People have been very worried, and analysts are quite distanced, and shareholders in the main, there are a lot of analysts that are quite distanced from actually what is happening at ground level related to valuations, and they've happened very quickly over a very short period. And combine that with the rates that are in the market, it's not surprising at this point that they trade so badly. I mean, remember this time last year, Zim barely got its public offering off. It's been a darling for the last 11 months. It barely got the offering off. a few months before that, as you point out, dry cargo was trading at a discount to NAV. So,
anyway, the point I was trying to make, Robert, is that when you have low freight rates, that can justify trading below NAV. But I have a hard time understanding the below NAV trading when you have high rates. Anyway.
Yeah, but that's simply because in dry cargo at the market at the moment, they're caught up in this massive fear of what is going to happen with the major buyer in the world, China, right? That's what's happening there.
So going back to the product tanker market, based on your significant career and experience, where are we in the cycle right now for product tankers? And is there any historical period that reminds you of where we are today?
No, it's a bit hard to, because we just haven't been at this place where you've got such severe things going on. You've got a very, very low inventories. You've got very low new building orders. You finally, as James had said, for the first time in the history of the product market, got aging. So, we haven't been in a point in the product market ever where your supply side is so constrained going forward for the next 3-4 years, and then constrained further by regulation. We just haven't seen that. Combined also with changes in dislocations in refinery changes that are going to increase the ratio of ton miles for products. So we are, whatever you want to call it, we're on pause. We're waiting. I don't know whether it starts exploding in March, April, May. Whenever people start to, travel and the cases start to come down, this is what's going to happen. We've already seen the reaction of, demand is reasonably strong. People want to do things in the United Kingdom. They want to do things in the United States. So probably next will be Europe that will follow.
So it is, you already answered this question, but it's coming from one of the analysts who follow the sector and the company. So I will address it to you. It says at your third quarter 21 conference call in November, management was excited about spot rates firming ahead of the upcoming winter market. However, 2 months later, that means now spot rates are still below cash break even. So while we all agree that we are in the recovery phase, do you believe that we will have to wait for the 22-23 winter market for a more substantial or sustained recovery? Or do you believe spot rates could exceed cash break even ahead of the next year's winter market? Difficult to have a crystal ball, but
no. But from the third quarter, announcement, the rates actually increased very substantially. It's only in the last, 2-3 weeks that the rates have fallen, and the rates are still, despite the stress. Think of what's going on in this market. I mean, it's amazing how strong the product tanker rates have remained in the face of hundreds of thousands of people in countries like France, United States, United Kingdom, getting COVID. That China is like, stop taking air flights around. I mean, the rates should be in the toilet at the moment. They're in actual earnings for modern ships. Remember, you've got to look in Scorpio Tankers' case at what a modern ship is earning with scrubbers, and that is very, very different than a older ship without scrubbers. And of course, we're in the point of recovery simply because of that basis. That you should have, the market should be absolutely on its knees right now. When you've got so much demand taken out because of Omicron, combined by demand coming out because people are still drawing down inventories. So we are in definitely the recovery phase, and we have yet another year. Think the difference between this year and last year, not just in terms of the product demand supply in terms of demand, but also around the world, but also in terms of that new building order book. Think of all the container orders and gas orders and dry bulk orders that went in the last 12 months. So yeah, we're definitely in that position. As I said, I have no idea, when that magic moment will be, whether it's, February, March, April, but the moment people can fly, that's great. And we will recover strongly in the spring if Omicron proves to be the kind of, final big tough one that could signal closeouts.
Thank you, Robert. In an improving rate environment, how are you thinking about capital allocation or alternative options like the lever, buybacks, dividend?
Well, right now we're focusing, as we've explained, on giving ourselves optionality. We've been building liquidity consistently all the way through COVID. We've been maintaining liquidity, maintaining forward liquidity, and making sure that's happening. And we've at the same time always said through this period that the moment we see, rates that are, going to be consistently above 17 a day, that's going to put us in a great position to have surplus liquidity, where the most obvious place to use surplus liquidity, if you've got a balance sheet that doesn't have much capex and doesn't really have much refinancing over the next couple of years, is to buy back stock when you have big dislocations between NAV and price.
I see. Okay, so let me now turn. I was leaning over to read the questions coming in. Let me turn to David for a moment and say, what does Scorpio need to do with its balance sheet over the next few years?
I'll answer that. David's not on this call.
Sorry, okay. I meant James. I apologize.
I'll still answer that question. So we have to, for the next month, what we're doing and what we're clearly trying to do is to maintain sufficient liquidity so that we're going to get through to this place of real recovery. As I say, that may be very short, that may take a few more months, or depending on whatever the worst case I see is, it takes until next autumn. But that I see as a worst case and least on the position. But until we get to that breakout point, we are going to focus on maintaining its liquidity. We also are starting to build the flexibility in our balance sheet to take advantage now of the big increase in our or our big improvement between our loan to value on our assets, which means that there are some financings that we have in place already that are, let's say, at very high costs. Margin is quite high. Some of them are 450, 500 basis points. So even if we don't feel we have the degrees of freedom to do significant buybacks, we will still have the degrees of freedom to start to improve the actual cost of financing as we're going through this.
Robert, since we started talking about balance sheet and lending, what has happened to the lending market over the last few years? Are we seeing any significant change? I mean, that's a question for you or James, after you two.
Yeah, we're seeing a lot of change. We're seeing, a lot of conventional lenders, commercial lenders are pulling back. They're pulling back whether or not they just don't want to lend to shipping. They're pulling back because they're getting very choosy on what they're able to lend, and they're faced with quite intense competition from the Chinese leasing companies that are getting more and more and more flexible along the way. Now, I think there is a continual place, and I think that you'll see us actually you know, we will probably do, you know, a couple of traditional bank financings next. There's still a strong place for that in the diversity of the balance sheet, but that's the sort of story you're having to, you know, it's the diversification.
So given the current rate and the investment environment, what are you seeing from shareholders today in terms of interest and in terms of type of investors interested in the product tanker space?
I think you're seeing waiting right now. I think you're seeing an extraordinarily volatile broad market out there. And I think you're seeing that investors who own tanker stocks largely have done the work on them and, you know, let's say, confident in the companies that they have in terms of the broad fundamentals, and are therefore in a holding position, you know, holding for the future and maybe adding along the way. But you're lacking, let's say, the marginal buyer, and you're lacking any conviction in the market, quite rightly, because there's a fear on rates, and they're not really having, and there's no blame to it, the investors are not yet really getting right into their face the data points that of the improvement in asset prices.
Robert, we had an analyst webinar last week, and the consensus among the analysts was that exactly the tanker space is a sector in waiting in terms of recovery. So, I mean, you already touched upon the market. If you want to elaborate a little bit more.
But we're waiting for that unknown position. The unknown position is, you know, how quickly do we get through this Omicron now into a period where, you know, people are buying freely, where traders know that next month's demand is clearly going to be higher. There's not the fear of lockdowns, not the fear of a meltdown of not being able to have drivers or people in supermarkets to work, etc., etc. That's what it's there. I think the actual fear and the reluctance for people to bid up the stocks right now is quite understandable. But I also think that it's going to. I think that to the degree that the rates improve and the investors get guideline at that point, you know, I think you will see very fast, solid gains from the tanker stocks because of the real weak pricing that they have at the moment. It will change. I mean, as I said last year, it's not going to be anything different than what happened with containers or dry bulk. Both of those two companies, people doubted and doubted and doubted and doubted them until, you know, suddenly they got some confirmation that sale values were going up and rates were going up, and then they exploded.
And I would also add that, you know, rates were improving from November through December in all markets, large ships, small ships. The MR market in Asia, Europe, and the US was working on all cylinders for the first time since COVID started. It's only, you know, a few weeks into the new year, and we've had the Omicron impact, and it's really hard to measure what that is. But if you come out of the Omicron impact, you know, refinery utilization is still high, inventories are still low. That incremental demand is going to come back, and it's going to have to, in certain cases like Latin America, Africa, Southeast Asia, it's going to have to be imported, right?
I would say, yeah, you asked the question just before, Nicholas, about, I think you said, started with an analyst has talked about rates, and now they're, you know, back below, you know, cash break-even levels. Well, I think that the rates are, in any modern tanker fleet, are above their operating cost and interest levels. They may be below their all-in cash break-even with full principal repayment, but they are above their interest and operating by quite a significant rate. And if your assets are not going down, in price, they're not depreciating. That means you are adding value every day to the company. And if you have a excess of value between headline value and loan, your loan to value part is improving, you may technically be, earning less money than your all-in break even, but you are actually adding value to the stock each day, or your net asset value, and you're not in any issue if you can refinance along the way, or you have enough cash on the balance sheet that the differential just doesn't really matter. I think that's something that people have sort of missed in the detail.
That is a very interesting observation, by the way.
So,
Robert and James, I don't have any more questions that have come in. So I would like to thank you for being with us. Maybe any concluding remarks?
No, I mean, we really thank all those people that are supporting us. We know as much information as anyone else watching Fox News, CNN, BBC, anything else when it comes to the COVID. But we are seeing the continual signs that, as we've seen in this period right now, that look at the cup half full, see what's out there in terms of concerns and how strong the product market still is. Look at what is happening in human nature. I mean, as soon as the restrictions come down, flight bookings increase, prices go up, etc., and they'll happen more so now. And appreciate the patience, and we're working to make sure that we will be able to take advantage of whatever shape the market is in over the foreseeable future.
So thank you very much for being with us, and I'd like to remind everybody that this presentation will be available for access upon demand, and I'd like to thank you all for being with us today.
Thank you.
Thank you, Nicholas. Thank you.